You've read the books. You've watched the gurus. You've chased the charts. And still, your portfolio feels unstable. One week you're confident. Next week you're questioning everything. Let me ask you something real. Are you losing money because the market is unpredictable, or because your thinking is? Most investors don't fail from lack of information. They fail from emotion, overconfidence, fear, impatience. They confuse price with value, volatility with risk, dividends with safety, growth with certainty, and the market punishes those confusions without mercy. In this video, we break down Security Analysis by Benjamin Graham and David Dodd, not as a textbook, but as a psychological weapon. You'll learn how to read a balance sheet without illusions, how to detect manipulated earnings, how to think in probabilities instead of predictions, how to protect yourself with margin of safety, and most importantly, how to build the kind of mindset that survives crashes, hype cycles, and your own impulses. This isn't about getting rich quick. It's about not being destroyed slowly. If you've ever panic sold, if you've ever chased hype, if you've ever needed to be right, stay with me. By the end of this, you won't just understand investing better. You'll understand yourself better. And that's where real returns begin. Chapter 1. You think you're investing, but are you just hoping? Have you ever noticed how you feel safer holding a stock certificate than holding your own doubt? You say you want financial freedom, but what you often want is relief. Relief from uncertainty, relief from fear, relief from the quiet voice that whispers, "You might be wrong." Security Analysis was written by Benjamin Graham and David Dodd in 1934. In the shadow of the Great Depression, the world had just watched fortunes vanish like smoke. Men who thought they were kings of Wall Street stood in bread lines. Graham had lived through it, not as a spectator but as a wounded participant. He saw that speculation, blind optimism, and borrowed confidence had ruined not just portfolios, but character. So he asked a harder question: what is a business truly worth? Not what the crowd shouts, not what the ticker flashes, but what the numbers, the assets, the earnings, the balance sheet quietly say. Graham wrote that investment is most intelligent when it is most businesslike. That line is not about spreadsheets. It is about discipline. It is about separating price from value, emotion from evidence. This might sound cold, even ruthless, but the market punishes warmth without wisdom. In 1979, Daniel Kahneman and Amos Tversky discovered through prospect theory that people feel losses twice as strongly as gains. That bias, loss aversion, explains why you panic sell at the bottom and chase at the top. You are not fighting the market. You are fighting your own wiring. Graham understood this before psychology gave it a name. He designed a method, margin of safety, to protect you not just from bad companies, but from your own impulses. Ask yourself, when you buy, are you calculating, or are you escaping uncertainty? Because the market does not reward hope. It rewards clarity, patience, and a mind that does not tremble when the crowd does. And if you cannot master that mind, no formula will save you. Chapter 2. You read the headlines, but do you read the balance sheet? Be honest. When was the last time you opened a company's financial statement before opening your trading app? You scroll through news. You watch analysts. You listen to confidence dressed as certainty. But Graham and Dodd built Security Analysis on a quieter battlefield, the balance sheet. They wrote that the true investor studies assets, liabilities, earnings power, not stories. They broke businesses into parts: current assets, long-term debt, working capital. They asked, if this company closed tomorrow, what would remain? What is tangible? What is air? This is not romance. It is inspection. In Chapter 4 of their work, they focused on asset values, especially net current assets. Graham even developed a method of buying companies priced below their net working capital, what later became known as net nets. This sounds mechanical. It is not. It is psychological armor, because markets inflate narratives. But numbers, when read carefully, resist fantasy. This might look boring, Boredom is often the gatekeeper of discipline. Studies on overconfidence by Barber and Odeen in 2001 found that frequent traders underperform, largely because they believe too much in their own judgment. The more certain you feel, the less carefully you look. So ask yourself, do you avoid financial statements because they are complex, or because they remove your illusions? A balance sheet is a confession. Debt tells you what management feared. Cash tells you what they prepared for. Inventory tells you what they misjudged. Marcus Aurelius wrote that you should look at things as they are, stripped of legend. Graham did the same with companies. He stripped them naked, removed the glamour, left only structure. If you cannot read a balance sheet, you are not investing. You are trusting. And trust, in markets, must be earned by evidence, not borrowed from charisma. So slow down, open the report, study the bones of the business, because price is noise, structure is truth. Chapter 3. You worship earnings, but do you understand their tricks? Have you ever felt proud of a company just because the earnings looked strong? That's the trap, because earnings are not a fact. They're a story told with numbers, and security analysis doesn't treat earnings like a trophy. It treats them like a suspect. Graham and Dodd wrote that reported profits can be shaped, smoothed, even staged, not always through fraud, sometimes through accounting choices that are perfectly legal. Depreciation schedules, inventory methods, one-time gains, deferred costs, reserves quietly released when management wants to look steady. This is why they pushed the investor to separate earnings into two types: what is repeatable and what is temporary. In their chapters on the income account, they warned against accepting a single year's results as reality. They urged averaging earnings over time, because business is cyclical and management is human. This might sound paranoid, but in markets, naivete is expensive. In 1999, Daniel Schrand and Terry Warfield found that managers with stock-based incentives were more likely to manage earnings to hit targets. That's not evil. That's incentives doing what incentives always do. So when you see a company beat expectations, ask yourself, did they build strength or did they build appearance? Nietzsche said people don't want truth. They want something that helps them survive. In investing, that survival instinct becomes dangerous. You want the clean number because it calms you. It gives you certainty. But the stoic move is different. You don't chase comfort. You chase what is real. Earnings are a mirror, but sometimes it's a mirror in bad lighting. So you look deeper. You ask, where did the profit come from? Operations? Or a one-time asset sale? Improving margins? Or cutting what cannot be cut again? Because the market can forgive a weak quarter, but it punishes a false foundation. And if you don't learn to interrogate earnings, you will eventually pay for someone else's performance art. Chapter 4. You fear volatility, but do you fear permanent loss? When the price drops, what do you actually feel? Is it logic or is it threat? Your pulse rises. Your screen glows red. You call it risk. But Graham and Dodd made a sharp distinction. Volatility is not the same as danger. In security analysis, they argued that true risk is the probability of permanent loss of capital, not temporary price swings. Read that again. A falling quote is noise. A broken business is damage. In their chapters on senior securities and bond analysis, they focused on coverage ratios, asset protection, the margin between earnings and fixed charges. They asked, if adversity comes, can this company survive it? Not will the stock dip, but will the enterprise endure? That mindset changes everything. In 1985, Mayer Statman found that investors often confuse volatility with risk because it is visible and immediate. The brain reacts to movement. Losses trigger the amygdala, a survival response. You are wired to escape discomfort, not to analyze it. This might sound harsh, but your biology does not care about your portfolio. Stoicism teaches you to separate what appears frightening from what is truly harmful. A storm looks violent, but a strong ship does not panic at waves. It fears structural cracks. Sun Tzu wrote that you must know the terrain before entering battle. In investing, the terrain is the balance sheet, the debt structure, the competitive position. If those are solid, volatility becomes a test of patience, not a signal to flee. So when your holdings fall, ask yourself, has the intrinsic value changed? Has the earning power collapsed? Has the margin of safety disappeared? If not, then your fear may be louder than the facts. The market will shake you. That is its nature. But the real danger is not the shaking. It is owning something that cannot stand back up. Chapter 5. You want certainty, but the market only gives probabilities. Have you ever caught yourself thinking, just tell me the right stock? That's not investing. That's begging the future to behave. Graham and Dodd never promised certainty in security analysis. They promised something more honest, a way to think in probabilities, a method to reduce foolishness, not eliminate uncertainty. They wrote about valuation as a range, not a single number. They showed that value depends on assumptions, earning stability, asset quality, competitive durability, and the interest rate environment. Even the cleanest model can't predict war, policy shifts, or human stupidity. So they built a philosophy, not a prophecy. This might sound disappointing, but disappointment is the price of realism. In 1967, Paul Slovic found that people struggle to think statistically, especially under stress. We crave a single answer because the brain hates ambiguity. That's why hot tips feel comforting. They reduce complexity into a simple move: buy, sell, hold. But complexity doesn't disappear just because you refuse to face it. Seneca warned that we suffer more in imagination than in reality. In markets, you suffer because you imagine certainty exists. You imagine that smart people know. You imagine that if you just study enough, you'll never be surprised. Then surprise arrives anyway. So the investor's job becomes quieter, even lonely. You weigh evidence. You accept what you cannot control. You build a margin of safety because you know you will be wrong sometimes. Not maybe. You will be wrong. The twist is, you don't need perfection. You need survival. Machiavelli understood this in politics. Not because he loved cruelty, but because he saw how fragile power is. One mistake can collapse a kingdom. One bad bet can cripple a portfolio. So you don't gamble on precision. You protect against ruin. Ask yourself, are you searching for certainty because you want results, or because you can't tolerate doubt? Because the market does not reward those who need to be right. It rewards those who can afford to be wrong. And stay standing. The video is half finished. If you like the video, be sure to comment and watch the next steps. Chapter 6. You chase growth, but do you understand its price? Let me ask you something simple. When you hear high growth, do you feel excitement, or do you pause? Because most people don't pause. They lean forward. They imagine speed equals strength. In security analysis, Graham and Dodd treated growth with caution. They did not deny it. They questioned its stability. They asked, how much of this expansion is durable? How much is already priced in? How much are you paying today for a future that may never arrive? Growth is not magic. It is reinvested capital earning high returns. If returns fall, growth becomes expensive decoration. They warned that when investors project current growth far into the future, they begin to speculate. Not invest, speculate. You start paying for dreams, not cash flows. This might sound restrictive, but overpaying for growth is one of the fastest ways to destroy capital. In 2018, Bissembinder found that a small percentage of stocks accounted for most of the long-term market gains. That means most growth stories do not become legends. Yet investors behave as if every rising company is the next empire. That's optimism bias, the belief that the future will cooperate with your narrative. But the market does not care about your narrative. Nietzsche spoke of the will to power, the drive to expand. Companies feel it. CEOs feel it. Investors feel it. Expansion looks like dominance, but expansion without discipline leads to fragility. Sun Tzu would say, Extend only when supply lines are secure. So when you analyze a growth company, ask, what is the return on invested capital? Is the debt rising faster than earnings? Is growth funded by profits or by promises? Because high growth with weak economics is a sprint toward exhaustion. And here is the harder truth. You are not just buying growth. You are buying expectations. If those expectations are extreme, even good results can disappoint. So ask yourself, are you investing in strength or in a fantasy that makes you feel early and clever? Because the market humbles cleverness, but it respects restraint. Chapter 7. You think dividends are safe, but safety has a hidden cost. Have you ever bought a dividend stock just to feel calm? Like the payout is proof the company is real. Like the cash in your account is a shield against doubt. Graham and Dodd respected dividends, but they didn't romanticize them. In security analysis, they treated dividends as evidence, not virtue. A dividend means the company produced distributable earnings. It also means management chose to return cash instead of reinvesting it. That decision can be wise, or it can be a confession. They warned that dividend history can seduce investors into false security. A company can maintain payouts while the business decays, using reserves, selling assets, or borrowing. The dividend becomes a performance, designed to keep shareholders loyal. This might sound devilish, but dividends can be used as anesthesia. In 2015, Baker and Wergler showed that investors tend to cater toward dividend-paying firms during periods of uncertainty, preferring perceived stability. That preference is emotional, not purely rational. People don't just buy yield, they buy relief. Stoicism would call that a dangerous trade. You are paying with truth to purchase comfort, because a dividend is not safety. Balance sheet strength is safety. Earnings durability is safety. Competitive advantage is safety. Dividends are just distribution, and sometimes they're a trap. Machiavelli wrote that appearances often matter more than reality in politics. Dividends can play that same role in markets. They signal stability, even when the structure underneath is weakening. So ask yourself, is the dividend covered by free cash flow? Is payout ratio rising because earnings are falling? Is the company starving itself to keep you calm? Because a business that cannot reinvest wisely may choose to bribe you instead. And you will accept the bribe if you fear uncertainty more than you respect reality. So don't ask, what's the yield? Ask, what's the cost? Because nothing in markets is free, not even comfort. Chapter 8. You think you own a stock, but you're renting a mood. Have you noticed how your conviction changes with the price? One week you feel like a strategist. Next week you feel like a fool. Same company, same fundamentals, different quote. Graham and Dodd understood this psychological trap before most people had language for it. In security analysis, they described the market as emotional, sometimes rational, often not. The price is not a verdict. It's a mood. And if you confuse mood with truth, you will become unstable. They pushed the investor to anchor on intrinsic value, the estimated worth based on assets, earning power, and sound assumptions. Not because valuation is perfect, but because without an anchor, you drift into whatever the crowd feels today. This might sound abstract, but drifting is how people lose decades. In 1999, Schefrin and Statman described the disposition effect. Investors tend to sell winners too early and hold losers too long. Not because of logic, but because of emotion. You want to lock in pride. You want to avoid regret. The portfolio becomes a stage for your ego, and the market uses your ego against you. Stoicism teaches you to separate your identity from outcomes. You are not your wins. You are not your losses. You are the one who chooses your actions. The same applies here. You are not a genius because a stock went up. You are not cursed because it went down. You are either disciplined or you are reactive. Nietzsche warned that the herd punishes the independent mind. In markets, the herd punishes it first, then rewards it later. That delay is what breaks people. They can't tolerate being early. They can't tolerate looking wrong before being right. So ask yourself, do you own the business, or do you just own the feeling it gives you? Because if your confidence rises and falls with the chart, you are not investing. You are renting identity from price action. And price action is a cruel landlord. So build your anchor, study the company, write your thesis, because when the market shakes, only what is written in your mind will remain. Chapter 9. You want to be right, but can you survive being wrong? Let me ask you something you rarely admit. When you invest, do you secretly need to be right? Not profitable, right? Because being right feeds the ego. Being wrong wounds it. In security analysis, Graham and Dodd built their entire framework around one quiet admission. You will make mistakes. No method eliminates error. What matters is whether your errors are survivable. That is why they insisted on diversification, on conservative estimates, on a margin between price paid and value received. Not because they lacked intelligence, but because they understood human fallibility. This might sting, but the greatest threat to your portfolio is not ignorance. It is pride. In 2005, Kammerer and Lavallo found that overconfidence drives individuals to enter competitive environments believing they are above average. That bias doesn't disappear in finance. It intensifies. You think your analysis is sharper, your timing better, your insight unique, and then reality corrects you. Stoicism doesn't demand that you avoid ambition. It demands that you prepare for correction. Marcus Aurelius reminded himself daily that he could be mistaken. That habit wasn't weakness. It was armor. Sun Tzu would say, leave yourself an escape route before battle begins. In investing, that escape route is position sizing. It is liquidity. It is refusing to bet your future on a single conviction, no matter how elegant it feels, because conviction can turn into obsession. And obsession ignores data. Ask yourself, if this investment drops 40%, what breaks? Your ego or your financial stability? If the answer is stability, you're gambling. The paradox is simple. You don't survive by being right all the time. You survive by never allowing one mistake to end you. And that requires something rare. Humility, enforced by structure. Not emotion, not hope, structure. Chapter 10. You don't need a perfect system. You need a hardened mind. Before we end, answer this honestly. Do you want a method? Or do you want a shield? Because that's what security analysis really is. Not a book about picking stocks. A book about building a mind that doesn't collapse under pressure. Graham and Dodd wrote with the calm of men who had seen chaos. Their world had already burned once. They weren't interested in excitement. They were interested in survival and rational advantage. Their core message is simple. Price is what you pay. Value is what you get. And the difference between the two is where your future lives. They gave you tools, asset valuation, earnings analysis, bond protection, intrinsic value, margin of safety. But the tools were never the final point. The final point was the temperament to use them when everyone else refuses. This might sound intense, but markets are not gentle teachers. In 1974, Kahneman and Tversky discovered the availability heuristic. People judge probability by what feels vivid and recent. That's why after crashes, you see risk everywhere. After rallies, you see opportunity everywhere. Your mind becomes a weather vane, turning with the latest storm. Graham's framework resists that, not with optimism, with grounding. Seneca said a man is as unhappy as he has convinced himself he must be. Investors suffer the same way. They convince themselves they must always act, always respond, always do something. But action is not power. Self-control is power. And here is the final twist. The market will always offer you a deal. Sometimes it's a bargain. Sometimes it's a trap. You won't know which one it is by looking at the chart. You'll know by looking at the business and by looking at yourself. So the real question becomes, can you stay patient when others get greedy? Can you stay calm when others get scared? Can you stay rational when your own emotions demand a shortcut? Because in the end, The market is not just a place. It's a mirror, and the person you become while investing is the real return. Thank you very much for watching my video, and please like and subscribe to my channel.